we're here today to talk about planning for retirement, thinking about retirement. It's more than just the finances, and you should really start thinking about retirement at any point in your career. Maybe you could answer some of your own questions. Maybe your parents are thinking of retiring. So we're just going to kind of move forward, talk about some basics, and then all the answers are kind of based on your unique situation. Disclaimer, I am an attorney, but this is purely informational. It's not legal advice. So, just make sure that if you were to ask a question that you're not providing any personal information. A very brief introduction of myself. I've had a career of helping employers provide income to employees as retirement income. So if you have a retirement plan at work, I had been helping employers like your employer provide those plans. And then I've been a professor at the John Marshall Law School, and I've taught law students how to help employers establish the plans. I established a couple months ago my own consulting firm, Retirement Help, where my focus is to go into small employers and help educate the employees about retirement in generic, objective, sort of like what we're going to talk about today, just so that they're educated. We're all University of Chicago graduates, and we all understand the importance of being educated first before you make a decision. And then you could just see my education and my certifications. So today's agenda, we're going to move quickly through a couple of key topics. First, we're going to talk about financing retirement. That is an important part of it, but it's not the only part. Then we're going to talk about some taxation issues that are unique to retirement that even you should start thinking about now, because some of the tax issues you can't really change once you're in retirement. So if you start thinking about them now and you have 20, 30 years, maybe you can actually do something. How do you leave a financial legacy after you pass away? Fourth, we'll talk about decisions over property and body. That's kind of, you're still alive, but somehow you're not able to make decisions over your own property and body. Fifth, we'll talk about the difference between medical care and long-term care. There is a unique difference, and it really becomes apparent when you reach retirement. So we'll talk about that. Where do you live in retirement? That's something we'll talk about. And then just some other issues. So that's kind of going to take up today's hour or so. And then your questions, time permitting. So you have 3 handouts, obviously a copy of this PowerPoint presentation, but I prepared a handout that's not just this cute presentation and all of the cartoons I have in it and stuff like that, but more of a chart that you could actually hopefully use. How does the issue that we're talking about impact your retirement planning? What questions or issues do you want to investigate? And then other comments. So this is kind of a piece of paper that you can take with you when you talk to your advisors, and it's not just a copy of a handout. I also included an essay I wrote a couple years ago that's published by the Society of Actuaries. It was kind of, the audience there is for other professionals. It was written on retirement planning, but it really kind of in writing is going to emphasize all of my thoughts during the first part of the presentation, which is how to think about financing your retirement. So let's start with financing retirement. There are some moving parts to it. And again, everyone is in a unique situation. So this is really at the very basic level of what you should be thinking about and what you may need to talk to your own personal attorney or accountant or other advisor. But what age will you retire, or what age do you think you're going to retire? What will your health be at that point in time? What will the health of your family members be? What will your monthly fixed expenses be, and how will you pay for your recurring and unexpected expenses in retirement? Now, obviously, you're not supposed to sit there have an answer, but the idea of this is educating you so you can start thinking about these issues, and if there's a problem point for you, you know what you need to do in your family to solve it, or at least understand what's going on. So financing retirement, we're all working right now, or hopefully we're working right now, and while working, sorry, that came too fast. So how do you pay your bills and maintain your lifestyle right now? It's most of us, we work and we get a paycheck. And that kind of dictates our standard of living. Hopefully all of us are kind of within our means. And then how do you keep a reserve and save for retirement? So if you are lucky enough to make more money than you actually need to spend, you could be putting away for your kids' education, for retirement, for the vacation, whatever it is. So payday comes, most of us get a weekly or bi-monthly or monthly paycheck. That dictates how we pay our expenses that are budgeted. And then we have a savings account, and hopefully we keep putting money in, but as we need to spend money, we take it out. And that's kind of what happens while we're working. I try and explain that retirement's not really any different. There will be some monthly income to you. Some may be fixed and some may be variable. We'll talk about it in a second. And I know a mailbox is a little outdated these days, but I don't know how to draw, a direct deposit. So if you think of a mailbox, it's the visual I want you to be thinking of, that every month or every week or whatever, you go down to your mailbox and there will be a check, and that's your fixed income. And then you have whatever wealth you've accumulated over your life and your career. The common term is a nest egg. That's what we usually talk about when someone's in retirement. If you took an economics class here at University of Chicago, it's called your endowment. It's whatever your net worth is. So income coming in from some source, think of a mailbox, and the spend down of your endowment. That's really all you have in retirement. And we're going to talk a little more about what an annuity really looks like and what the spend down of the endowment looks like. So there's a gamble. And I'm not here to tell you that if you hear the word annuity or fixed income, that it's right or that it's wrong or that it should be 100% of how you think about retirement or 0%. There's a gamble between the two. And I just want to put this out here at the beginning. With an annuity, so let's say I turn 65 and I have an insurance company or Social Security or a pension plan or someone, Linda, who's going to write me a check for $1,000 for the rest of my life. Okay, she has some idea when I'm going to die, and that's how she's figuring out how much it's going to cost. Okay, so with an annuity, the gamble is so there are actuaries out there that work at insurance companies and stuff and kind of predict what the average life expectancy is. I'm not trying to overwhelm you, but just that's what you pay for. The actuaries determine, and right now, if you're alive at 65, men generally are assumed to live on average till about 84. Women have a larger life expectancy till about 86. So, someone is thinking that I'm going to be around for 20 years and I'll get $1,000 a month for the rest of my life. It's a gamble. If I die exactly as expected, then I got exactly what I paid for. A shorter life, then I lose, because the person paying that annuity did not pay me for as long as they wanted. They thought I was going to be alive till 84. I died at 76. They won. Okay. But on the other hand, if I live a longer life, I win. I'm still alive at age 94. I still go down to my mailbox. There's still a check in the mail. So it's a gamble. What about just spending down your endowment, taking out money each year? Again, if you plan it perfectly and the best thing is the day that you took that last dollar out of your savings account is the day that you die, perfect. You died exactly as planned, but it's a gamble, remember. If you live a shorter life than expect to say, okay, you died sooner and you didn't spend all your endowment, and that is what's going to be left to your family and friends and charity. However, what happens if you live longer than expected? At some point, your limited wealth that you've accumulated up to retirement is going to zero out. And at that point, you have no further endowment to draw on. So the idea, again, think about it from your family perspective, how you're going to do it. Most people who have a successful retirement have a certain portion of annuities that come in and pay the fixed expenses, and a certain portion of the spend down of the endowment. And together, that may be the right mix for you. But again, when you hear of annuities or not, just understand there's a gamble, and it all depends on what the actuaries expect you to live, what your life expectancy is expected by the actuaries, and what you actually die. You know, we all know some unhealthy people who are still alive in their late 90s, and some very incredibly healthy people who are expected to have a long life who die early. It's a gamble. Just understand the gamble. Risks with annuities. So annuities, there's inflation risk. So if I, right now in 2019, I'm 65 and I get $1,000 for the rest of my life, as we all know, inflation eats into that. So if I'm still alive in 10 years, $1,000 may only have the purchasing power of $800 or something. So if I care about that, I may pay more to the person providing the annuity to have an inflation rider. Social Security automatically has a cost of living adjustment. So again, $1,000 a month, I'll get that for the rest of my life, but is inflation going to start eating into it? An emergency risk with an annuity, I can't receive extra income to pay unexpected expenses. So I'm on a fixed income, and if I have a bad thing happen, like medical emergency, or the roof needs repairing, or even a good thing, you know, my granddaughter is getting married and I want to give a gift. If it's a fixed income, you really can't take anything extra. And there's the financial fitness and integrity risk. So again, if I go to a A-rated insurance company, chances are they'll be around to pay me the $1,000 a month. No offense to Linda, but if Linda promises to pay me, is she still going to be around to write that check for $1,000 every month? The risks with your endowment, we talked about longevity risk. You know, again, you're going to outlive your money, you're going to spend down everything, and then what do you have left? What a lot of people don't think about, and they get into trouble, is investment management risk. As you're getting older, as your mental cognitivity kind of recedes a little, you're still expected to kind of be making decisions about your nest egg, your endowment. How do you keep it invested? How do you make sure that the purchasing power is there and stuff like that? So even you know, if you, unless you ask someone else to do it for you, you know, as you get into your 70s, 80s, 90s, even as a University of Chicago grad, your mental cognitivity kind of declines with age. It doesn't mean you have dementia or Alzheimer's disease, but you still have to make proactive investment choices with the endowment, whereas the annuity, some insurance companies making all the decisions. As long as I get the $1,000 check in my mailbox, I don't care what decisions they made. And the last one is spendthrifts. Again, you know, it's just taking money out of the savings account or something. So it's easy to take more than you need and blow it on a nice trip to Italy. That's great, but that may mean that you run out of money sooner. So again, I'm throwing a lot at you, but I'm trying to just educate you. Financing retirement, you know, there are really two choices. There's the fixed income that comes in, sort of like your paycheck right now, and there's the spend down of your endowment. And I'm just trying to show there's the gamble, there are risks. Find the right balance that makes sense to your family in your family situation. So financial service professionals, there are really three ways they think about financing retirement, and when you meet with your financial service a professional, you have to let them know what makes sense for you. So the first one, and this is the camp that I generally fall into, especially for my clients who are not super wealthy. Even if you're making a nice living, my idea is ensure that there's enough fixed income to pay all your expected fixed expenses, and then just take ad hoc distributions for any unbudgeted expenses. Two other ways to look at it are is whatever annuity payments you have, use them, and then draw down from the endowment by a specific amount, like 4% per year or 2% per year, whatever it is, and then perhaps with some guardrails based on each year's actual gains or losses or inflation. And the third way that advisors kind of think about it is maybe in some sort of situations just have different buckets of where you're going to take your money from. So maybe there's, you know, the bucket of the stocks and bonds accounts that'll last your first 5 years of retirement, and then maybe the houses and real estate you own are in a different bucket. They're years 6 to 15, so you start liquidating them over 6 years so that you have them. So again, the way that I like to discuss with, you know, people that are not absolutely wealthy is the first way. I think if you know that you have enough annuities to pay your expected fixed expenses, then however you spend your endowment over time is going to kind of last as long as it can. But again, this is stuff for you to think about. You may be hearing about this for the first time. You're not supposed to be sitting there and understanding and figuring out what's best for you. But now that you've kind of heard it, you could go back, you could think about it over time, and you could figure out what works for you. Here's just some examples of some fixed income in retirement. So Social Security benefits are annuities, pensions and annuitization of your account balances. So, you know, some of you still work for employers that have what's called a defined benefit pension plan. And, you know, when you retire, you choose monthly income. Annuities purchased from like a private insurance company or from organizations. Some people prefer bonds that pay interest over a certain period of time. So you could discuss a bond ladder with your financial professional. Stocks that pay predictable cash dividends. If you have a business and you sell it in installment. If you have rental properties or Airbnbs and you get regular rental income, that's money that's going to be in your mailbox every month. Royalties, if you've written any books or made any creations, alimony and other family supports, again, those are still monthly checks that come into your mailbox. Reverse mortgages with an income stream, or if you have money and you establish a trust and you get income coming back. Again, these are just examples of, think of the mailbox, and if you have enough of this type of income coming in each month, then your monthly bills will be paid. Examples of how do you spend down your net wealth. Obviously, it's if you have checking accounts, savings accounts, money market funds, it's the cash distributions. It's also getting lines of credit against your property or your business should you need it. It's selling off any personal property, anything from grandma's engagement ring to whatever, you know, your living room furniture. I mean, you know, in desperate times, this is all part of your wealth. And again, as you need more money, you may need to sell more of your property. And there are viatical agreements on life insurance. You know, there's a regulated market, and if you're terminally ill, at least these are the laws in Illinois. If you have less than 6 months to live, then you can legitimately sell your life insurance policy or other guaranteed future income to someone who's willing to buy it. So I quickly want to go into Social Security because, and I'm talking about this assuming that the government never takes away Social Security, that anyone who has benefits will be preserved. You could have difference of opinion on the politics and the public policy, but I could only explain what Social Security is now under the current laws and that we should plan on benefits from this. So the Social Security normal retirement age. When can I start getting money from Social Security? Since I was born after 1960, my Social Security normal retirement age is 67. That's when I get my full benefit. I can take a reduced benefit as early as age 62, and I can postpone my benefit and take a larger one at age 70. So all of us, the first chart shows what our normal retirement age is, but all of us are allowed to take an earlier benefit as early as age 62 or a larger benefit if we delay beyond 70. I don't know what's right in your situation, but this is something that you can talk to your financial advisor or your accountant or your attorney, especially as you're getting up in your 60s, and what is the best for you to do. Now, a couple of quick points about Social Security. Social Security is usually an irrevocable decision, so you have to think about it, but once you start your benefits, they're generally locked in. One thing that a lot of people do not realize is before your Social Security retirement age, if you start taking Social Security, but that's not enough and you want a part-time job to supplement your income, or you're just bored and you want a part-time job, up until you reach your Social Security normal retirement age, your Social Security benefits are going to be reduced if you're also earning earned income. So, don't just get that part-time job, or don't just sell your business to your kids and still continue working and receiving a salary if you're collecting Social Security benefits and they've started before your Social Security normal retirement age. So again, these are things that if you know about it ahead of time, you can plan on when it's best to start Social Security. Two quick bullet points. If you're married, the rules are still, Social Security came in 1935. It's been changed a little, but men worked, women didn't, and the rules are still kind of bent that way. So if you're married, spouses might get the larger of their own Social Security benefits, or their spouses. So again, if you're married, you may want to coordinate, especially if you don't both turn Social Security retirement age in the same year. And divorced couples also, there's still the rules in there that if you're divorced, you may be able to get higher benefits based on your ex-spouse. So again, I'm throwing a lot at you. Absorb it, understand, but this is, all the stuff that goes into financing retirement, and it's better if you start thinking about it now over whatever horizon you have, as opposed to today was, your 65th birthday, they gave you a gold watch at work, and tomorrow you start retirement. Here's a final thought. I think this is cute. A friend of mine, Tom Hegna, came up with it, but most Americans could be millionaires except for two things. They spend way too much on cars and they get divorced. So the moral of the story is drive a used car and stick with your first spouse. That will help you have more financial strength. Now we're going to move on to taxation issues. It's still about kind of financing, but it's a different way of looking at your income. So some of the moving parts, what will your marginal federal income tax rate be in any year? Could you have planned in advance to be in a lower income tax rate if that's what you want? What about your Medicare premiums? That's something that very few people think about. That is very important in the tax discussion. And do you live in a state that has an income tax regime? So we're going to talk mostly about federal income taxes, but some states also have a state income tax, and you have to kind of think about that. Again, that doesn't mean that's the reason to move away from your family and friends just to avoid taxes, but if that is something that is important to you, well, think about it ahead of time. So which income tax bucket will your actual distributions and realized income come from each year? So the tax code changes all the time. Again, I'm looking at current law, but I'm also, if you've studied income tax policy, while the rates may change here and there are generally some truisms that run through, and I'm going to kind of have you think about the different ways that whatever income you receive is going to be taxed, and chances are it's not going to change that much, even if another Congress raises a rate or lowers a rate. So there are generally about 5 different ways to look at taxes. There's income tax rates, there's a preferred tax rate, there's some income that will never be taxed, other than possibly the alternative minimum tax. There are some penalties that you may incur that are just one-time penalties, and then there are some other issues. So normal income tax rates, whatever the rates are and the tax brackets we have, during retirement, it's going to be your distributions from your IRAs and retirement plans. You receive $200,000, you're going to pay taxes on $200,000 at the normal rates. Any compensation, just like right now, any compensation you earn. Rental income, if you're a landlord and you own some property, interest from regular bonds, gambling winnings, gifts from other individuals, and sales of business. So these are all normal income tax. I'll have a quick example in a couple of minutes that it will make it a little clearer, even if you know nothing about taxes or don't care about taxes. Preferred tax rates are things like long-term capital gains on normal investments or antiques or collectibles. When you sell them, there's just a preferred rate, qualified stock dividends, and Social Security benefits, because under the current law, at most, 85% of your total Social Security will be taxed if you're wealthy enough. So that means your Social Securities actually come at a lower rate. Stuff that will never be taxed, if you have something called a Roth IRA or a Roth 401k, the money that comes out of that under the current law will not be taxed. If you have a qualified life insurance, however, that's defined in the Internal Revenue Code. If that's you have there's life insurance on your spouse and your spouse dies and you receive the life insurance, that's not taxable. Bequests upon someone else's death, benefits paid from a qualified long-term care policy, or interest from qualified municipal bonds. Now, again, there's not supposed to be class in taxation. I'm just trying to show you that there are different buckets, and if you plan ahead of time, you may get the result that you're looking for. One-time penalty tax, when you turn 70 and a half, you have to take what's called required minimum distributions from your IRAs and retirement plans. If you fail to take the right amount of money, you're going to be charged 50% penalty in addition to the taxes. Premature and early distributions from IRAs, and issues discovered on audit. So you can't always plan on penalties, but if you work with a competent accountant or an attorney, you could avoid any of those penalties. And then there's just some other issues that may or may not impact you. If you run businesses, there may be net operating losses. There are certain other things to think about. But so if you just kind of visualize again that there's some income that's going to be at a normal income tax rate, even if Congress changes that rate from time to time. There will be certain income that is at a preferred lower rate. There will be some income that you never have to pay taxes on, and then some other issues. But again, these are things to think about and talk with your advisor. After the Tax Cut and Jobs Act of 2017, the Trump Tax Act, if you want to call it that, it's a little harder to accumulate enough deductions from your home mortgage and your medical expenses and state and local taxes to have a benefit of more than the standard deduction, but your personal accountant could maybe help you. But there are certain credits and deductions that are allowed once you hit 65, especially if you're blind or disabled. So, even if this law never changes and this is how it is through your retirement, there may be additional ways to cut your taxes, even like retrofitting your home or doing some other things to help you. And even this is something that a lot of couples don't like to hear about, but sometimes, and I see it for a lot of couples, even if it's the first marriage, there are some situations once you're both in retirement that it may actually make sense to file separate returns. It's not, you're not divorcing your spouse, it's just the option is there, and don't overlook it. And then there are the other tax issues to think about also. Again, state and local. What, you know, if you retire in Illinois as opposed to retiring in Arizona, what's the difference between income tax, sales tax, property tax, registration fees? At the federal level, there are still gift and estate taxes. You have to be, for the federal level, you have to have an estate over, you know, $11 million. But in some states, like here in the state of Illinois, all you need is $4 million, and then you owe estate taxes to the state. And international, any of you who have property or citizens of another country, you know, think about that as well. So again, the idea is here not to make you a tax expert, but to have you start thinking about some of the questions to ask your personal advisors. So this is a quick example. It's a back of the envelope calculation. It's for illustration purposes only. I just want to kind of show how planning could affect your taxes. So let's just assume you need to spend $200,000 during 2019. You meet the maximum Social Security for 2019 is $3,770 per month, so that's $45,000. So you need $200,000 for your lifestyle. You're getting $45,000 from the federal government. You're over, say, 65. You're single, no dependents. So you need another $154,760. So again, this is a quick example. It's not all the alternatives, but just to show you. So if you have a 401k plan from your employer, it's not called a Roth account. So every dollar that comes out is taxable. You take that $154,760 from your taxable 401k plan. Based on the current rates, you'll owe about $41,000 to the federal government in taxes. So at the end of the day, you took $200,000, write a check to the federal government for $41,000, and you really have $160,000. And that's because you crossed into the 32% bracket. My example here, let's assume you planned and you had a Roth IRA in addition to your 401k plan. And instead of taking the $155,000 from the taxable 401k, you only need to take about $132,000 from the taxable 401k. And you have this other bucket, you have this non-taxable income, and you could take about $22,000 from that. The difference is now you only pay $32,000 in taxes because for your taxable income, the $132,500, you're still in the 24% bracket. You didn't cross into the next bracket. So again, if you were just waiting to complete your 2019 tax return until April 15th of 2020, and you had already made your decisions, that's it. You owe in taxes what you owe. You can't do anything different. If you understand ahead of time that if you do some planning and you figure out, well, maybe a certain portion comes from my taxable and a certain portion comes from my non-taxable and a certain portion comes from my preferred, maybe you can get into a more desired tax position because, again, there's nothing illegal or nothing wrong with minimizing your taxes, but it has to be thought out ahead of time. So the first step is, from the last slides, over time, get money into different, get your wealth, get your income, get your endowment into different buckets so that as you take money out, it will be taxed differently. And then the second step is, now that you know the current rules, however they are, and you know, and you have money in different buckets, now you could strategically decide how you take money out from each bracket to kind of minimize your taxes. If you're a CPA or you're a graduate of Booth School, you probably could do this yourself. If not, hire someone. But it takes you thinking about it to actually make it happen. And now the last thing I want to talk about on taxation, again, something that people don't understand, and we'll talk about Medicare in a couple of slides, but everyone who turns 65 is going to enroll in Medicare under our current laws. Medicare is not means tested. Every American citizen is going to get it. But right now, I'm just showing you the premiums that you pay for Part B is based on what your income was 2 years ago. So it's 2019 right now. The chart that if you go to Medicare.com, they tell you if your income in 2017 was, and then you look at the chart, it tells you what your monthly premium is. So most Americans are paying $130 or so per month for Medicare Part B, but the wealthier Americans are paying more. And so again, this is the chart for 2017 telling you in 2019. I can't predict what's going to happen 2 years from now, but based on my last example of, do you have $150,000 in taxable income or 132? If these numbers represented your income in 2019, based on the example from a couple slides ago, and the premium, there's the difference between if you had the Roth IRA and you took some non-taxable income, then you would only be paying $352 a month for the Part B premium. But if you only took the money from the traditional 401k plan and you paid that higher, so now you had $154,000 of taxable income, all of a sudden you would be forced, you have no choice, to pay $433 per month for your Medicare Part B. So again, planning on your taxable income is going to affect how much you pay for Medicare Part B premiums 2 years from now. So again, planning is going to at least eliminate surprises. Sometimes you may not be able to control what income is taxable and what's not taxable, but at least now you understand 2 years from now when the Social Security charges you an extra $100 a month for your Medicare Part B premiums, you could at least understand why it is. It's because of what your income was 2 years ago. So now let's talk about your financial legacy. How do you plan to leave money to your heirs, to your friends, to your alma maters? Do you want a school at University of Chicago named after you? Legacy. First, I want to, just provide some information about what probate is and what wills are and trusts. And so let's start from the very beginning. Probate will happen, regardless what anyone ever tells you. This process called probate will happen. It's a court procedure. So wherever your residence is when you die, whatever county that is, so if you're living in a nursing home in a different county than your house was, that's the court in which probate will happen. It's the county where you died, and these are, although each state has their own kind of separate rules, this is what probate is. It's a public procedure, and it's generally about 9 months. Lawyers are going to charge about 10% of what your estate is worth that's getting probated. And basically all creditors and taxes are paid first before any of your family members or your charities or anything else is paid. And because it's a court, whatever the judge decides is final. So I'm not meaning to scare you, but there's no way to avoid probate. The later part of this slide, we'll talk about things you could do to avoid probate on certain assets, but probate happens. So here's the difference between having a will or not having a will. If you die and you have a valid will in the state that you die in, then the judge follows your instructions. Now, there are some issues with wills. First of all, it has to be discovered. There are some people who create a will and they hide it somewhere, not even in a safe deposit box. It's just hidden somewhere and no one ever finds it. This is actually interesting. We're seeing it with the Aretha Franklin, I'm sorry, just went, that when she first died a couple of months ago, there were a lot of news stories that she died without a will. And then now a couple months later, as people are going through her houses and stuff like that, now they found actually 3 wills. So now a judge is going to have to decide if any of them are valid, if any, so it's complicated, but that's kind of a story of, did she have a will? Did she not have a will? If you do a will with your attorney and when you die, it's presented to the probate judge and the judge decides everything is fine, then the judge will follow the instructions for the will. Otherwise, your state where you die has intestate statutes, which will only divide your estate between your living relatives, and in a proportion that's under state law. So your charities will never get any of your money. Your friends who took care of you while you were sick will never get any of your money. So the first part here is a will is very important. None of us know when we're going to die, especially if you have children. A great place to talk about who's going to take care of the children and what money is going to help that person raise your children now that both you and your spouse are dead or whatever it is. The will be followed by the judge. Otherwise, the judge is going to follow the state rules. Okay, so probate will happen. I'm going to show you a couple of things that you can do to protect some assets, but like if I die today, I'm wearing a watch, I have clothes, I have personal property. You can't protect everything. So the idea is probate will happen, and again, they're good and bad, but you have no choice. Someone has to do probate. So all property that you own at death is included in probate, except, and now we'll go through 4 exceptions in all the states. They may have different rules, but these are how you could protect your property to not go through probate. Property titled so that the survivor becomes the owner. So if you're a married couple, chances are your state has something called tenancy by the entireties. So if I and my spouse own our house jointly, when one of us dies, title automatically under Illinois law goes to the other person. We don't have to do anything. So therefore, it's not part of the probate estate because the law dictates that's how it goes. You may have property titled with your child or with your brother or sister or someone else that it's a joint tenancy with right of survivorship. So think about how your property is titled right now. If you don't know, talk to an attorney. And think about if you just titled it differently, can it go to that new owner upon your death without that property needing to be in your probate estate? Property passes through transfer on death rules. So a lot of older people, and they have children that help them out and stuff, they may want their checking account or savings account to kind of go pass to the child so that the child can pay for the funeral expenses and some other things. If I have a checking account and I just put my child's name on it right now, we could be looking at gifting because my child now has the right to, if my child's named on the checking account, then my child has the right to take money out right now. So the transfer on death rules is kind of, it's kind of naming the kid as a beneficiary. So on death, once my child would show the bank teller my death certificate, now the child has the use of that money, and probably it's hopefully enough to pay for the funeral, pay for some of the other things. So again, if you just want someone to have access upon your death, but not currently, look, to talk to your bank, talk to anyone else, but see if your state has these transfer on death rules, and then you can name the person. Proceeds paid through a valid beneficiary designation form. So life insurance or IRAs, by law, the life insurance company that I have a life insurance policy, if there's a valid beneficiary designation form, by law, the insurance company is going to write out a check for the death benefits to whoever I said it. It doesn't have to go to a probate court. and we're keeping that stuff out. So again, you have property titled, so that's usually your real estate. Your transfer on death rules, that's how you can do some, savings accounts and checkings accounts, and beneficiary designation forms. The fourth one is what a lot of people talk about and don't understand. Property that has been fully funded into a trust. And the next two slides will talk about what a trust is. If that's been done before you died, then any property that is in that trust will avoid probate. So again, probate will happen, but most of us, we have some, personal savings accounts and checking accounts. We have, real estate. We have life insurance, and we have other large items that if we do some planning, and planning costs money, lawyers are not cheap. I'm one of them. I understand that, but with proper planning, you could carve out the important assets that you don't want to go through probate to pass under law because you've done some things to avoid probate. Now, before I go to the next slide, go back to the left-hand side of the slide. It's a court procedure that's public. Now, not everyone is going to go, when the day you die and your estate is up there, not everyone in the world is going to go into the courtroom. But on the other hand, since this is what I study, a lot of times when I have nothing to do, and I live in the city of Chicago, I will go to the 18th floor of the courthouse and just sit in randomly on estate hearings, just because this interests me and I like to see what happens. But all I'm saying is probate is it's open to the public. So a lot of times the people have planned properly. All that's being debated there is, grandmother's engagement ring and some of the, personal property that hadn't been put in a trust. But, but if that's important to you of keeping it private, then, that's something to consider. But again, probate will happen. If there's a will, the judge follows your instructions. Otherwise, they follow the state and intestate statutes. And if you want certain assets to avoid probate, this is the stuff that you have to plan and either title the real estate, go through the transfer on death rules, make sure your beneficiary designations at your life insurance companies and at all your employer retirement plans are up to date and proper. And if you go that extra step and create a trust or several trusts, that you actually fund the trust and rename the property instead of in the name of Barry Kozak, I go and pay for whatever it costs to put the property under the name of the Barry Kozak Revocable Trust. So what is a trust? It's really just a legal document that provides instructions to a trustee. It's how to own, manage, or sell or distribute the property. It names who are the beneficiaries who can receive the distributions. It's what are the conditions and decision points to trigger a distribution, how the trust can be amended, and how trustees can be removed. So that's all the trust is. But every state kind of has their own specific laws on what legally makes a trust a valid document, so that it's its own entity, and any property owned by the trust is not owned by me who created the trust. So again, when it comes to a will, it's a legal document. There are a lot, you could go to a lawyer, anyone who calls themselves an estate planning attorney, maybe some other attorneys. These days you could do a little cheaper route and go with something like LegalZoom or something like that. But remember, you kind of get what you pay for. My suggestion as an attorney myself, do it once, do it right, find a trusted advisor and get it done. The wealthier you are, or the more issues you have with your family, the more expensive it's going to cost because you have special issues. But remember, a trust, it's just a legal document. Now, why use a trust? Obviously, avoid probate. We just talked about that. But perhaps you want to provide asset protection for future lawsuits. Maybe you want to legally plan to qualify for Medicaid or something. Maybe you want to minimize your income or estate taxes. Maybe you have complicated charitable donations. Maybe you want to protect your children from your earlier marriages. Maybe you want to distribute complicated property like guns or fine art. Maybe you have beneficiaries who are not U.S. citizens. Maybe you have succession planning. There are various other reasons. So again, if you're going to go the way of using a trust, you have to find a competent attorney. This is something that's generally expensive. This is what they charge for, because their job is to create a trust that accomplishes your goals after you've passed away. So now let's talk about decisions over property and body. Go through this quickly. So decisions over property and body. In all 50 states, we can make decisions over our property, which includes everything from our house to our car and everything, and decisions over our body and health. This pictorial kind of shows, the medications that we want to take, the surgeries that we want, our care, but under the rules, it's also our funerals and how we want to be remembered, and also organ donation. So these are all decisions that we can make over our body and health. So you can make decisions over your property health if you're an adult, that's generally 18 years old in all states, and you have this thing called mental capacity. So what is the legal analysis of mental capacity, which is slightly different than the medical, but let me give you the legal analysis. The individual, you, me, Linda, communicates goals to a professional. Whatever the goals are, I want to create a trust, if that's what your goals are. So the professional gives you the choices and risks. Here's how much it'll cost, here's what you'll gain by doing a trust and all that. The key here is now, so the individual communicates the goal, the individual is given choices, the individual thinks about it and communicates a decision to the professional. That's mental capacity. So mental capacity depends on the decision, though. So I'm going to try and explain. It's all kind of subjective, that what one person may think is proper mental capacity of an other individual may differ from someone else. But let's just think about it like this. So let's stick with wills. If you do a simple will, you're on your first marriage, and you come to someone and you're of sound mind and you're leaving everything to your family, however you understand that family to be, whatever level that is, whatever I would expect as an attorney of the mental capacity you show me today, if you came to me, the same person, the same day, but you're on your second marriage and some of your money is going to go to a charity, I have to expect a higher amount of mental capacity from you today at the same meeting. All right, whatever I would have accepted for a simple will, I have to think you really understand the consequences of donating half of your money to a charity, and you're on your second marriage and how that affects it. Same meeting, same person, but you come to me and you want to cut off one of your 3 children. You have to demonstrate a higher level of mental capacity to me than the others. So again, there's no right or wrong answer. It's just, what are you trying to do? And the more complicated the task is, the higher level of mental capacity we expect from you. Okay. Now it's time and place. So an adult with Alzheimer's disease, maybe grandma has been diagnosed with Alzheimer's and she's deteriorating, but we still may be able today, she might have enough mental capacity to execute the will today. However, someone who hasn't been diagnosed with a dementia, but is really tired or really depressed, that individual might not have enough mental capacity. So who decides? If we keep it between friends and family, that's the simplest thing. So a lot of time, estate planning and elder law attorneys can kind of have a committee of several family members kind of decide when, mom can no longer drive, or when mom can, must be moved into a nursing home or something. The next level is medical doctors. Once there's a medical diagnosis, that can't change, and that kind of, although it's private, it's kind of gotten to a level that you can't change. And the highest level is a judge. But once a judge decides, that's the legal determination. So if mom is declared mentally incompetent by a judge, that's it. Mom is declared mentally incompetent. So if you plan ahead of time, maybe you could keep it where it's just between friends and family. So if you're still alive, but you have diminished mental capacity, who makes decisions over your property or health? So if you plan properly, then you select an agent to provide those instructions, and otherwise you will be a defendant in an adult guardianship hearing, which costs a lot of money and emotion if you ever have seen a public adult guardian hearing at your local courthouse. So how do you plan? There's this thing called a power of attorney. Most states have a separate power of attorney for property and a power of attorney for health. And again, these are documents that you do now while you have your mental capacity to kind of name an agent, determine what authority to give that agent, what limitations, how do you do it. Again, anyone who calls themselves an estate planning attorney or an elder law attorney, or maybe some social workers, there are a lot of people who understand powers of attorney and can help you through it. There are also the sites on the internet that you can go to prepare powers of attorney. But just remember, there's a higher chance that you're going to be disabled but still live than die, especially in accidents and these days. So this is something that you really want to prepare for. It's not necessarily retirement. I could get hit by the car going home today and have brain damage and not be able to make decisions. So this is something that you just want to think about. So now we're going to move on to medical care and long-term care. So right now there are 4 parts of Medicare. I know we're in a presidential election. Maybe Medicare will change over time, but right now there's Part A, which gives you hospital benefits, Part B, which is the normal doctor benefits, Part C, where if you want other things like vision or hearing, and Part D, which is prescriptions. It's all medical care. I'll explain that on the next slide. Long-term care is not medical care. Long-term care is just care when someone becomes frail. So just these visuals, I want you to just kind of see. So this is my definition of what medical care is, just so you could understand it. Medical care is a trained and licensed medical professional, does something to ameliorate your body or mind to improve your health. Once they cannot do anything to help you improve, such as the term plateau, it's no longer medical care. We go into the world of long-term care. The next slide, I'll talk about how expensive medical care is versus long-term care. So that's why it's important. Long-term care is just any untrained person, maybe your spouse, maybe your child, maybe the neighbor down the street, helps you with any of the activities of daily living, which is bathing, toileting, eating, dressing, transferring, or some other incidentals activities of daily living. So it's not a trained professional. They're not trying to get you better. They're not doing anything to your body. They're just helping you with the activities of daily living that if you didn't bathe or you didn't go to the toilet or you didn't eat would lead to health issues. But how we pay for it is different. That's why it's important. So medical care, once you turn 65, there are 4 parts. The premiums for Part A are free. That's what you paid through your payroll taxes. We already talked a couple slides ago about what your monthly premiums are for Part B. It's higher based on what your income was 2 years ago. And that's just to have the coverage. Then there's an annual deductible that you have to pay, and then there are co-pays. Kind of probably like the insurance that you probably have now while you're working. There are no annual maximums. So you could purchase some types of plans to help you. But the problem is, especially with Part B is your normal preventative and non-emergency medical care. And basically, Medicare is going to pay 80%. You have to come up with the other 20%. So which years are you going to be unhealthy, that you have a lot of co-pays? And again, there's no maximum. And how expensive will your temporary or chronic diseases be? You don't know what you're going to suffer from, and 20% of, one type of disease is a lot cheaper than 20% of a different disease. So again, you really can't plan this, but understand that's how medical care is. Long-term care is not part of Medicare. Basically, if you're going to go into a nursing home, think about $90,000. That's the average cost in America right now for a private room. And if you're going to hire people to come in at home, if you only need someone like 6 hours a day, $50,000, but maybe up to $200,000 a year. So long-term care is very expensive, and it's not part of the 4 parts of Medicare. How do you pay it? Either you pay out of pocket as needed. Maybe you have a long-term care insurance policy. If you're poor enough and you go to your state and declare welfare, you could get Medicaid. But what a lot of families do is get it for free from their family. And that's kind of, if that's what you're planning on, that your children are going to provide the long-term care, maybe it's time to have the discussion with them before they're expected to give up their lives and raise. And what we see a lot of times right now is people raising their children and taking care of their parents as well. And it's not always the best situation to just expect that your family is going to do it for free. So maybe purchasing a long-term care insurance policy or putting aside money for the long-term care. So where to live? So we're kind of almost at the end now. So where to live? So most people think that they want to retire at home. Based on 1965 terminology, when Medicare was written into law, that's called you're in the community. That it doesn't matter if it's a house or if it's an apartment or a mobile home, whatever it is. But remember, your house, the physical house may need a ramp, it may need an elevator, it may need no-slip bars in the bathtub. Are you going to retrofit before the crisis happens, or are you going to wait till the crisis happens? And unfortunately, people who don't think about it wait till the crisis happens. What about others living in the same house? If you remove all the rugs because that's a slip risk, is that going to affect other people in the house? What is the general dependence? And now you're living at the house. Who's going to maintain the property and snow the sidewalk, shovel the sidewalk when it snows and stuff like that? These are things to think about. Doesn't mean you can't do it, but it's easier to think about it now and plan than wait till the emergency happens. If you go to an institution, obviously there are bad apples, but there's some really good places out there. They're not all nursing homes. Some of them kind of have a continuing trajectory. There are professional staff. There is socialization. That's something that a lot of people who age at home become isolated. There is some regulation, and the patient remains a family member and not the caregiver. So just institutions aren't horrible, and maybe that's where you want to think about. So just in the last 2 slides or so. So I'm hoping that I'm educating you that, develop a retirement philosophy for yourself so that you retire into your next phase of life and you're not simply retiring from your last job. Your philosophies don't need to match those of your spouse, children, and siblings, but it's easier to talk about it ahead of time than wait and see. Oh my God, you wanted to travel and all I want to do is play golf. Talk about it now. What will you do to remain socially integrated and good health, physically and mentally, and to be happy? And what happens if you need to become someone else's caregiver or some other person needs to provide care to you? So make a plan and revise the plan when anything unexpected happens. Plans are good. It's a starting point. Make sure you revise it. Communicate the plan. So living documents that you like powers of attorney, communicate have discussions with your children and your spouses and your siblings and your friends. Copy your documents, carry them with you. Your wills and stuff, that's the stuff you preserve the original in a safe place, but let your loved ones know where that is, how to get to that safe deposit box. Some things we didn't talk about today: there are programs and laws that benefit people in retirement, such as property tax abatement and grandparent rights. Elder abuse is a big problem, so there are laws and programs to protect people from elder abuse. We didn't talk about prearranged funeral programs or gifting assets or anything else on this list. I'm just trying to run through it. You could read it yourself. So there are a lot of things we didn't discuss. So as a recap, this is the last slide. Hopefully you now understand some of the things to think about, and you're going to need professionals to help you plan to finance your retirement, optimize your tax profile, plan for your financial legacy, plan for your decisions over property and health, make sure that you're properly insured to cover your medical and long-term care expenses, and help you to plan on where to live, and also importantly, how to develop a retirement philosophy. So if you already have a trusted professional, contact him or her. If not, feel free to contact